Garrett Gunderson.
All right, buddy. Thanks, brother. How's everybody doing? That's what I remember from last year. I love this crowd. I love this group. I love the energy. And the thing is, it's time for us to get rid of all of this nonsense out there in the world that if people just scrimp and save, if they just sacrifice and delay, that one day, someday, they can retire. Let's redefine retirement right here, today, right now. I heard Mitch talk about Steve Jobs. You know what? He had more money than he could have ever spent, but he still showed up doing something every single day because retirement means to go out to pasture. But instead, if we are engaged in purpose that's greater than who we are at this moment right now, we stay engaged for a long period of time. Like the wealthiest icons in the world, they didn't look to retire. That wasn't their goal. That wasn't their objective. Their objective was to do something that mattered, that was meaningful, that pulled them towards greatness. So what if retirement meant you retired from the things that you hate? You retire from budgeting. Who's ready to retire from budgeting, by the way? Yeah. That doesn't mean we're going to become reckless and overconsumptive and spend every dollar we make, but instead, let's achieve economic independence as quickly as possible, and Renatus is such an amazing path to get there. Economic independence is when you have enough investment income, first and foremost, or entrepreneurial income that comes in whether you show up to the office the next day or not to cover your expenses. Now, if you get to that point of economic independence, it means that every dollar that you actively earn moving forward is no longer encumbered by lifestyle. And this is such a major advantage because that's what I call the fast track. When every dollar you earn doesn't have to go towards expenses for living, it can go towards building assets, buying real estate, and creating more cash flow. And the rest of the world is going to say, how do you do it? It seems almost unfair. It seems almost impossible because they don't have the methodology or the philosophy, and it seems invisible to them. It doesn't even seem credible, but they see your life. And here's the deal. If you get economically independent, you could be a stand for greatness and an example for others that they can achieve it too. Yeah. So I want to retire from the notion of retirement and instead have you retire into purpose. Retire from the things that you hate. Embrace the things that are very best about you, because I think within all of us is a soul purpose. And I mean S-O-U-L. Soul purpose. And that's our values, it's our abilities, it's our passions, combined for the highest context of living. And see, vision is that highest context of living. What is your vision for life? What is your vision for business? What is the impact that you're looking to create? See, because vision is the rarest of commodities. Vision is the rarest of commodities. Yet vision drives more value than anything else in the world, and dollars follow value. So if you want a lot more money in this world, it's all about the vision you have, and vision can't just be words, it has to be action. It has to be example. So as you go through the education, as you learn about all the things you can do in real estate, it's about implementing that so that you can create that economic independence. And then when you have economic independence, you're going to have a different level of confidence. You're going to have an ability to swing for the fences in everything you do, knowing that you're not going to harm your family. You're not going to put them at risk. Because is anyone in the room married to someone that just has a little different money personality than them? Like, isn't that kind of what makes attraction sometimes? You've got the entrepreneur, they're crazy optimist, every idea is going to work out, let's go for it. Then you got the other person that's more like rational, reasonable, like, well, shouldn't we have some money in savings, and shouldn't we maybe do a couple of things first, and are you spending too fast? The thing is, when you get economic independence, it brings couples together where there could be support, because if you do something that's a big vision and it takes a little bit of time to come to fruition, you've got staying power. You're not putting your family at risk. You're not harming anyone if it takes longer, or if it's one of those expensive tuitions. Anyone else in the room had an expensive tuition? Like when you just do something and it was like really stupid and it didn't work out, and you're like, it would have been cool just to listen to someone that told me not to do that, but I thought I would try it anyway. Like, this reminds me of my grandpa. So my grandpa, definitely a hero of mine. I mean, I just really had such a special relationship with him. I still dream about him quite often because he died a few years ago, but he was the first one that I ever met that was kind of an entrepreneur. Now, For those of you that know me, know that I'm from a town 2.5 hours southeast of here, the thriving metropolis of Price, Utah. Yeah, Price. Coal mining town. My dad was a coal miner. My grandfathers, both coal miners, and my great-grandfathers were all coal miners. The good news, I've never stepped foot in a coal mine. Yeah, I can breathe through my lungs. It's really nice. I owned a business when I was 15. It was my first business. I spent a lot of time naming it. I came up with the name Garrett Gunderson's Car Care after about 20 seconds and named it that. And then with this business, I started detailing cars. And that's kind of tough work, you know, waxing cars and getting rid of tar and bugs. And then 6 months later, I spoke at this thing called SIFE, Students in Free Enterprise at Southern Utah. And they paid me $500 for taking third place. At the time, my business had $600 of net income, and that's why you have me here today, because I was smart enough to become a speaker instead of a car detailer, right? I mean, because we're no longer in the industrial age where people are paid for brawn. I mean, maybe if they're a CrossFitter, a few of them might get paid for brawn, but for the most part, we're in the world where we're paid for brains. And I acknowledge you that you're here investing in yourself, because invest first and always in yourself. And don't think of investments as stocks and bonds like the rest of the world, waiting for 30 years, hoping that the market will cooperate so that maybe you could live your dreams and go sit on a beach and do all these things that people defer and never experience. But instead, think of investments as investing into ideas and investing into people. People ask, well, how did you become economically independent? Or how did you accomplish what you accomplished? As I decided I wasn't going to invest in mutual funds, where these are companies that I've never stepped foot in the company. I don't know who the board of directors are. I have never looked at their financials, just because everyone else is doing that, and then waiting for 30 years, hoping that it works out. I decided to pay $25,000 for 5 straight years to be in Genius Network, or a program called Strategic Coach, or went through a program called Maverick Business. You know, like I just said, I'm going to invest in mentors. I'm going to invest in relationships. And when someone that's great says, hey, do you want to come and do this? When Bob Snyder says, hey, do you want to come do a Renatus course? I say yes, because I say yes to high quality relationships. And that's where wealth is built. Because if anyone here thinks they have a money problem, you actually don't have a money problem. And those that feel like they have a money problem are really pissed that I just said that. I know you want to hit me. I get it. I'm going to give the solution, though. A money problem is merely a symptom. And first of all, if you can write a check and solve a problem, you don't really have a problem. It's when you don't have the money to write the check to solve the problem. But it's not a money problem. It's a mental capital problem or relationship capital. Mental capital is your ideas, your knowledge, your wisdom, your tools, resources. It's information, right? And have you ever heard it's not what you know, it's who you know? That's not true, because if you know nothing, we don't want to spend time with you. We don't bring people up on stage. We're like, hey, here's Johnny. He doesn't know anything. Talk, Johnny, to the group. Everybody's in severe pain, like get him off the stage, right? Like mental capital is essential, and we're in a world with the internet and with real estate contracts where it doesn't even matter about your background, your ethnicity. You know, it's simply, do you have the intelligence to recognize where a deal exists where someone else doesn't? Or you have a mental capital where someone's in dire straits, they have no idea how to get out of it, but you find a way to make that profitable for you and get them out of their pain. That is a win-win exchange. Mental capital, that's the first thing. Relationship capital is the second. People, networks, organizations, mentors, family, friends. I mean, that's relationship capital. So if you have a lot of information, you don't share it with anyone, that's called potential. And what do we usually hear when we hear about someone that has a lot of potential? Like, oh, they have a lot of potential, but they just got kicked out of something, right? But they just peed on someone in the parking lot. You know, like potential, if people only talk about your potential, that's not always a good thing. Sometimes, but not always, right? So we got to be careful. We got to take that information, that knowledge, that mental capital, everything you're learning here, and then there's a bridge between mental and relationship capital. It's called business. Business is that bridge. And the bridge of business exists through exchange, through value creation, through serving others, and through solving problems. whether this has happened before or whether it's going to happen in the future. There are going to be people out there that see what you do and they want to take a shortcut. They saw that you made some money on real estate, so they become a real estate investor overnight. Yes, I saw what you did. I know I could do that. They're not going to get the education. Their education will be when they get their butt kicked by not knowing what they're doing. Because one of the things everyone has to figure out sometime in their life is that risk isn't in the investment. Risk is in the investor. And are you a risky investor or are you a good investor? And you're here to become a better investor. And those people that are not in the room are at a disadvantage right now if they're not learning this. And if they go out there and try to mimic or model, it's what I call Mongolian plumbing. Anyway, I should explain that, right? That just sounds like really mean. But what happened is the Mongols came over to Russia a long time ago in a war. And then they found out that these toilets would flush. And they were amazed. They're like, we've got to get these things back to the women at home. They're going to be so impressed. Flushing toilets. This is amazing. They'd never seen such a feat as the plumbing there. So they took the toilets out, put them on the carriages, and ran them home, right? How did those flush when they made it back to Mongolia? Yeah. Mongolian plumbing is when someone tries to model you without the depth of knowledge. It's when someone tries to mimic you without understanding everything else that you know deep down and inside. It's like this model I'm going to share with you today of economic independence. It's invisible to far too many, so if they try to only do a few pieces, it's not the whole picture. And if we do things with only a few pieces and not the whole picture, it's pretty dangerous. It'd be like, hey, I've been on a lot of airplanes, so I think I'm fine flying those. I mean, I've seen them push buttons and move things. So I could be a pilot. I mean, that's how ridiculous it is to think that someone's going to do really well in real estate without the knowledge. Look, I learned this firsthand. I have one of my good friends here today, and I'll introduce him to you. And he brought me my first real estate deal. He said, hey, I just need $25,000 for earnest money, and then I already have a buyer for this property. I'll double your money. It took less than 4 months for that money to double. And so I was immediately freaking brilliant, as you can imagine in my mind. I gave money, didn't know what the deal was about. 25 grand, 50 grand comes back. I annualize that rate of return, somewhere between 300 to 400%. I'm like a freaking genius, so I might as well go do real estate with no education. So my second deal, no money down, use my wife's credit. We buy a house in Vegas. We lease it back to the person who's behind on their payments, help them build up their credit so they could finance it. No money down, I make 90 grand. I might as well be the financial Einstein of the world. Now, by the way, everyone was making money at real estate at this time, in 2003, in 2004, especially in Vegas. Hell, you had to actually enter a lottery to buy homes in Vegas at that time. How fitting for Vegas. So much demand that you had to enter the lottery. I won the lottery, which wasn't the best lottery to win because I bought a home for $462,000. 5 years later, it appraised for $461,000. Not the best real estate decision I've ever made. But what I had to do was go through that expensive tuition because I didn't have the mental capital. I had the relationship capital in the transaction with my friend Derek that made a huge difference for me. I had the relationship capital that the next deal that was brought to me, they knew all the numbers, they knew the appraisal, they just didn't have the credit to get it. So I was able to give them a $5,000 finder's fee, pretty good for them, great for me. But we hear from Warren Buffett that you find out who's swimming naked when the tide rolls back. Right? And sometimes when the market's going up and everybody's in a frenzy, like, oh, I got to be a real estate investor, and your bellman's giving you tips on real estate and he's never watched a single video, that's when we know it's about to be the right time. Now, the rest of the world, the middle class, what they hear throughout their entire life is if you just scrimp, save, sacrifice, delay, defer, blah, 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 long haul, all the garbage that we see in the media. And by the way, it's this type of talk that gets me kicked off CNBC. Apparently they don't like when you say this stuff. That's all right, because ABC Good Money had me on 13 times. And the first time I was on, some of my advice was stop funding a 401k. And they were like, we usually don't get that kind of advice around here. I said, Yes, and 98% of Americans when they turn 65 are not able to retire, so maybe it's time for a little different advice. You know, I mean, the advice that we're getting out there in the mainstream media is the opposite of what you're being taught here. It's all about one day, someday. It's not about cash flow. It's not about stewardship. It's not about knowledge. It's about handing your money over. And the formula is so antiquated. It's so broken. They believe that wealth is a function of A, how much money you put in. Who here has ever been taught it takes money to make money? You know who says it takes money to make money? People that don't put their money in but want your money that they can make money on. That's like the chicken and the egg argument. Was there money and then money had babies and that's how you make? No. You know how you make money? Value, resourcefulness, exchange, service, solving problems. I mean, hell, even Jerry Seinfeld said, I was told to put my money to work and my money should work for me, so I sent it out to work and I found out my money was lazy. Yeah, because if you're just handing it over and abdicating responsibility, hoping that it's going to work out. I know people that from 2008 to 2010 stopped opening their retirement plan statements. I was like, why? They're like, well, I don't want to get bad news. I'm like, the bad news is you're still in the plan. Okay, so the first part of the formula, it takes money to make money. That's the first thought. That's erroneous. That's why I wrote Killing Sacred Cows, to dispel that myth. The second error, they say it takes money to make money. The next part of the wealth formula for the poor and middle class is high risk equals high return. To get a good rate of return, you've got to take a lot of risk. Once again, who's telling people this? Those people that are taking no risk, like AIG, when you've given them money and then they lose it, and then your tax dollars help pay them back so you can get your money back. High risk, it doesn't take high risk to equal high return. I know so many people in Renatus that have done amazing real estate deals that took very minimal risk. They had good collateral. They didn't have a whole bunch of cash tied up in it. And when it's cash flowing right from the beginning, and you know what you're doing, how risky is that? The more knowledge you have, the less risk you take. The more emotion you have, the more risk you take. High emotion equals low financial IQ. High intelligence equals lower risk. It's a pretty simple formula. And most people sell on hype, like CNBC. Hey, the market's down. What do they tell you to do when the market's down? You gotta buy because you know what? It's on sale. By the way, tickets just went on sale for this conference for $1. But if you've already bought them, you're SOL. That's a bad sell. You already bought it. Hotels, they're paying for your hotel if you haven't booked yet. But if you did, sorry, you had to pay full price. We don't want to buy things after, we don't want to hear about things going on sale the day after we bought them or the year after we bought them. So high risk equals high return is an error. So wealth equals money times rate, and then their third component, by time. This is how they believe very linearly wealth works. If you just wait long enough. Now, if the plan doesn't work, guess what they tell you to do? Put more money in or wait longer. Who said wait longer? You deserve a book. That was good. No one else participated in that but you, so I'm giving you What Would the Rockefellers Do? All right. Hey, this is $1,000 on Amazon that I'm handing you right there, you know? Hey, you're welcome. Thanks for the participation. I have a few others, don't worry, you get your shot. Some of you are still mad that I said if you have a money problem, it's not a money problem, and you're still angry. But remember, it's an idea or relationship problem, which means you're only one idea or relationship away from the next level of prosperity. How many people here know and love Woody Woodward? I mean, that dude, when I met him, I don't know if I could calculate how much money that guy has made me in my life from A, his thinking and ideas, and B, just the relationships he continually connects me to. He connected me to Bob. So I invested in Woody's program, and I got things I didn't even expect. Here were the two things I didn't expect to get that I got. Number one, he figured out my wife's emotional fingerprint so that I could figure out how to stop being an idiot sometimes and really have a better relationship there. And it's been phenomenal. Number two, you saw my one son come up on stage. I'm making sure that I get to pay him for being here today and get a tax deduction on that, as Mitch mentioned. So yeah. You know, I'm putting them to work. They'll be working the rest of the event with me out in the hallway, so that I can justify paying them $1,000 a month. That would be low tax or tax-free, right? You got to figure out ways, and mowing the lawn doesn't really cover it. But the second thing that Woody did for me is my kids. They're a lot like me, not surprisingly. I mean, one has purple hair, the other one has green hair. I'm a financial guy with long hair. I mean, we don't really go with the mold because the mold is bad, right? Doesn't mold make you sick? So we kind of break that mold and believe in some individuality and expression and like, let's do some things that make us happy and live the life that we love and at the same time serve a whole bunch of people. Well, he helped me figure out when they were struggling in school, their emotional fingerprint, their core values, and then I was able to really acknowledge what they had that was so gifted that no school could teach them. Like the green-haired 9-year-old that came up, that dude at a table of 12 high-level entrepreneurs in Denver, Colorado, had them laughing and rolling out of their chairs for an hour and a half, telling stories and jokes, and he oozed charisma. I mean, he'll probably one day make me look like I'm a horrible speaker because he's just absolutely got that. The 11-year-old has such a deep, deep compassion and caring for people and for animals and for, you know, all. So it's like he could win you over with this really deep soul. And those are the things that matter in the future. Your ability to memorize doesn't mean anything. Your ability to connect, your ability to create, and your ability to adapt is what will allow you to thrive moving forward. So I just mentioned all of this because investing in mutual funds wouldn't have got me Woody Woodward if I'd have been like, oh, it's $10,000 for his program. But by investing $10,000, I know it's been multiple six figures in my life. As a matter of fact, I was just in St. Petersburg, and just that event alone that he brought me to was worth 6 figures to me, right? So you invest in people, you invest in ideas, you invest in mental capital, not money times rate times time. Money times rate times time is the slow track. It's the riskiest track of all, and it has people be completely out of control with their money. You're not in control of it. Someone else is in control of those outcomes. Some market's in control of those outcomes. And I know we all have dreams, whether we fully express them, whether we share them with everyone or not. But somewhere, somehow, people have all their dreams at risk based upon things that they don't control, but not you. You're here because you care about your own freedom and hopefully your legacy. Because when I wrote What Will the Rockefellers Do, I said, what matters most? It's even the relationships in my family, and not even my family, in my business and all the clients and all the people I enjoy life with. So why not have a book in the world of finance that talks about how do you create a legacy not just based upon the dollars, but also based upon legacy from a relationship standpoint, and that relationship capital through retreats, through the very things the Rockefellers have done. So anyone see the news this week? David Rockefeller died? 150,000 relationships in his Rolodex. Did you read about that and hear about that? 150,000 relationships. That's pretty crazy. He's a little old school. He had a room off of his library where he kept these in an actual paper format. I feel like I could have taught him about a paperless system, maybe. But still, think about that. Think about how much he valued relationships. And this is why the Rockefellers still have wealth for the 6th generation, and it's continuing to go strong, and they donated $50 million last year. The reason is because when they took and had this money, John D. Rockefeller said, okay, I want to pass this on, I want it to last, I want to build a legacy that lasts. They built a Rockefeller-style family office. Now, when I was 22 years old, that was the first time I experienced a family office. I went into New York City. I was shadowing this guy named Vince. He was very arrogant, but a well-known financial guy that everybody said was the smartest guy. When I first asked him to mentor me, he laughed and told me to leave him alone. I was 22 years old. But I was smart enough to know, he has a secretary, why don't I start sending her gifts? Why don't I start getting to know her? And then the secretary introduced me to his wife. I won her over. So now all of a sudden, Vince had no choice but let me come onto the meetings just like a little kid, right? Like, I will be in the meetings, I won't talk, I'll take notes. That first meeting was with someone on Wall Street worth $20 million. That was their net worth. How much do you think they had in the stock market? Any guesses? 5%. So everyone said zero, that's a great guess. You guys get where I'm going there? 5% of their portfolio. So they made their money selling the market, not utilizing the market. Do you see why the wealth equals money times rate times time is so broken? It just doesn't work. There's an entirely different model, and built within it, it's called cash flow banking, where we utilize something called velocity. And velocity works this way. We take the GDP of an economy, right? That's the total output. We divide it by its money supply, which is M2. And it tells us the velocity. What velocity means is how many times do dollars circulate in a given year? The more times they circulate, the more wealth. And yet I know there's so many people in the world that believe that there's a finite pie. There's only so much to go around. You've heard it over and over, right? You've heard people say, I can't afford it. Or that person's rich, so they must be bad. Or even the terms like filthy, stinking rich, or all this kind of stuff. When I grew up in a family so deeply entrenched in scarcity, I heard those sentiments quite a bit. As a matter of fact, I remember as a little kid waking up from a nap once. And when I woke up from the nap, I looked at this plaque that was on the wall of the trailer. And it said, money is the root of all evil, and it had a little devil. And coming out of a nap and seeing that devil, it kind of scared the hell out of me, to be honest. Now, it was our camping trailer. I like to just say trailer so you feel like I was, growing up in a trailer. But it was actually just, but my family really believed that. Some of my family were the epitome of this. They believed that they were going to keep the first dollar they ever earned. That if they could find a way to never spend anything, all the better. That scarcity mindset destroys wealth. There is no greater way to destroy wealth than scarcity. Because no amount of luck, no saving, no discipline, no rate of return, no financial advisor will ever save you if you can't conquer the scarcity mindset. And the accumulation philosophy of wealth equals money times rate times time is one of the greatest propagators of the scarcity mindset, because if you don't have enough money, you're never going to have wealth. If you weren't born in the right family, if you didn't get really lucky, because the higher risk you take, the higher the return you're supposed to get. But if that were true, wouldn't we just buy lottery tickets? Can you think of anything riskier? But all that is an ignorance tax. If you buy a lottery ticket, I guess it might be fun, but it's an ignorance tax. Anyone here won the lottery? Show of hands. Like, really won the lottery, not like you won $5, with your scratch-off card or whatever. I mean, it's like you look around, no hands go up. Because it's a game of luck, but wealth and prosperity is not a game of luck, it's not a game of chance. It's a very precise methodology, and velocity is at the core of that. So if we take the output divided by the money supply of an economy, and if the government says, hey, the economy's sluggish, let's print more money, does that actually always increase output if we print more money? There's never been a time in our country's history that we've had more money than right now. Never. They're probably printing it as I say. I don't even know if they have to print it anymore. I think it just shows up on computer screens, right? So it's not about having more money, it's about increasing output. There's two major ways to increase output. Two major ways. And if you look at your own velocity, all you have to do is say, what's my output as an individual divided by my input? And the more that output goes up by keeping input fixed, meaning not working harder, not sacrificing, not doing all that kind of stuff that most people tell you have to do, who in here is even capable of working 10 times harder? What if that was the name of my speech? 10 times harder for 10 times the profits. You'd be even more angry than when I said your money problem's not a problem. Like, that's just nonsense. It's not about working harder. What it is about increasing velocity. How do you do that? One way to do it is be more financially efficient. Keep more of every dollar you make. In the year 2000, from 98 to 2000, I was peddling mutual funds. I was selling life insurance. I thought I was doing a financial internship. I told people I was a financial advisor. I was a glorified salesperson. Almost all of our training was on building relationships, not on actually strategies and tactics and getting results. It was just how to get people to like you and stick around. And I was bringing my family members and my friends into the firm, and they were being sold all these things. And I got to tell you, 98, 99, for those that remember the show Doogie Howser, one of my clients called me the Doogie Howser of finance, because I was this really young kid, and they were making a bunch of money. And the reason they were making a bunch of money is because all boats rise when the tide goes up. The market just happened to be going up. It wasn't because of expertise, but fortunately, who here has that reality check framed? I had a buddy that was my roommate, and his dad was a client. And I got the Wall Street Journal every day because I thought, oh, yeah, that'll make me really rich if I read the Wall Street Journal at 18 years old. Makes you nerdy. I don't know if it necessarily makes you rich. But I'm reading that thing, and then he finds an article in there about monkeys that throw darts at a stock board, and then they find out how many monkeys are doing better than the fund managers. And the particular article he found, it was 78% of the monkeys were doing better than the fund managers. So he says to me, I called my dad, since he's one of your clients, and I asked him about the returns he'd been receiving, and I'm comparing you to these monkeys to make sure that you're doing a better job than the monkeys. Yeah, this is the same roommate that I put alarms under his bed before he'd go to sleep at night and wake him up at 3 in the morning. And when he would wake me up because he woke up, I would just chuckle and laugh. I mean, I deserved the punishment that I was getting here. But the thing is, I wasn't a financial Doogie Howser or Einstein. I was simply taking money that was in double E bonds, if you even remember those, and cashing them out and putting them in something riskier that did really well in 98 and 99 because everyone did pretty well, but the year 2000 came and the market started to go down. What do you think my firm told me to tell people? Oh yeah, long haul, it's on sale. Yeah, weather the storm, the market goes up, the market goes down, blah, blah, like, blah. They just vomited on me, you know? And I hate vomiting, I just don't like it at all. I had the flu a few weeks ago, I made sure not to vomit. That is my worst fear in the world. Just, you know, so write that down. Very important factoid. All right, if we have a little bit of fun along the way here, you know? I mean, who made the rules that finance has to be boring as hell and drab and dry and like, you know, overly technical? Yeah, it's billions of dollars of marketing to convince you to separate yourself from your money and not have enough insight to know when it's time to get out. I mean, their whole mantra is invest early, invest often, and invest always. And if you go against that, they kick you off, right? They don't like it. But those are all the sacred cows. Enough people are doing it that everybody believes in it. So, financial efficiency is one of the paths to velocity.